Y'all came back? Thank you. My name is Keith Ashton, the co-head of Alternative Credit with my partner, Joel, you just met. We're talking in this session about frontiers of private credit. And we don't mean by that this is new things. As you'll quickly surmise, these are asset classes that have been around a long time. The frontier element, however, is because in each case, which you'll hear about, we've hit something of an inflection point in both the market opportunity and growth opportunity for areas. So that's what you should be listening for. I'll start and then pass the clicker over to my partner, Craig, and then Patrick, and then Brian, I guess you'll bring us home. All right. As you heard my partner Joel discuss, alternative credit is a very large market that has a host of credit products that are used every day and underpin a lot of activity in the economy. One of the things that you should really understand is that the foundation of this market, a capital foundation of this market, consists of three main pillars. The first of these is banks. Banks are by far the dominant pillar of capital in this market. And then there is the asset-backed securities or securitization market, which transforms these asset portfolios into rated securities for institutional investors primarily, and especially insurance. And then private capital, which is a complementary pillar of capital that provides capital solutions that the other two pillars either can't or can't easily provide. But these pillars of capital are highly symbiotic. We all need each other, and the asset markets themselves need all three pillars to function properly. There's a long history in these markets, and that history is defined a little bit by how these three pillars shift in terms of their relevance and activity relative to one another. And without going into the whole history here, you can think about the last 5 to 10 years where the private capital pillar has played a much more significant role than in the past because banks and securitization markets emerged out of the GFC feeling more constrained. What's interesting is that the markets find these new balances or new equilibrium. And as we look at the market today, there's been some recent events that rhyme with banks that have created, again, another situation where these markets are going to find a new equilibrium among the three pillars. And we refer to this as the $12 trillion question. As we know and won't belabor, banks are facing two distinct challenges today in the market. One relates to their liabilities. Their liabilities are more expensive today, especially for their deposits. And those deposits' tenor, in particular, is less certain, shall we say. And I think everyone agrees is a little shorter than it used to be. And then on top of that, bank regulators are increasing the amount of capital that banks have to hold against these same kinds of assets. The $12 trillion number comes from the fact that if you look inside of bank balance sheets today, $12 trillion is the amount of assets that they have on those balance sheets, the same assets that are financed, owned, and invested in by the securitization market and private capital every day. So while banks will continue to play a very important role in this market, what's interesting that we see is that as these constraints and challenges are facing banks, the banks have to respond. They really don't have a choice in the matter. They have to recalibrate their balance sheets. So the $12 trillion question ultimately is, what percentage of that $12 trillion worth of assets is going to need to find a new home in non-bank capital, and particularly private capital? And this is why we think that for now and for the next 5 to 10 years, there's a bigger role for private capital to play in these markets. And the good news is that Ares is really well positioned and well resourced as an ability to participate in that growth and what we think will be the driver of alternative credit growth at Ares for the next 5 to 10 years. So with that, I'll pass the baton to Craig.
Thank you, Keith. So I'm going to start a little bit and talk about the opportunistic credit market opportunity today. As Aaron, my partner and colleague, mentioned before, our mandate is quite wide, and we like to think the definition of opportunistic credit today is effectively this wide highway that we can drive in between in corporate credit. On one guardrail, you have traditional distressed investing, which is much more episodic in nature. On the other side is traditional direct lending. And our deals tend to be a little bit more complex in nature, take longer, more bespoke in nature. So we have this wide highway to drive through within corporate credit, and depending on the market opportunity, dislocations or healthy, performing, non-performing companies. And we have the ability to kind of ascertain and use relative value in the platform to our advantage to get what we think is differentiated deal flow and investment opportunities. But I'm going to focus today on the market opportunity that we're active in today, and that's specifically dealing with aged assets on sponsor portfolios. And given the higher interest rate and volatile market environment, exiting assets and returning capital for sponsor-owned companies is very challenging today. And the PE community at large has an aged asset issue that they're dealing with. And when you look at the chart here on the left, what that means is effectively you see around 51% of sponsor-owned companies, and this is on a global basis. It's around 16,000 companies, over 31,000, are sitting on sponsor portfolio companies 4 years or more. Some even longer than that. And usually around years 3, 4, and 5 are when assets are starting to get sold back into the market. So it's creating this aged asset issue. And it's effectively the result of these three monetization paths, or I like to call off-ramps, being effectively shut. In 2018 to 21, in a low-rate environment, when cost of debt was much cheaper than where it is today, you saw a lot more frequent sponsor-to-sponsor transactions happening. That was a huge tailwind. That tailwind is now a headwind. As we know, rates have doubled. The cost of capital has doubled, I should say. Rates have gone up, and multiples have come down. So as a result of that multiple compression, you see a wider bid-offer spread. Buyers want to buy at today's value. Sellers are up here, pre-rate hike. And so you've seen a stagnation of sponsor sales within one another. Two, strategics are coming back, but not as quickly as you would think given the harder regulatory environment. And there's only been 14 sponsor-backed IPOs since 2022. So effectively, these three off-ramps remain severely challenged. And effectively, when we turn to the next page, this aged asset phenomenon, that we like to say, is effectively our pipeline. And it's our opportunity set today. And as you see here, there's around over 3 trillion of global unrealized NAV, i.e. sponsor capital that's been put into the ground and spent over the last few years versus only 1.2 trillion of dry powder. Historically, throughout my career, most of our careers, that ratio has been effectively 1-to-1. And that's kind of kept the PE machine rolling. But when you see this deficit of 60%, sponsors have to ask themselves specific questions, what they want to do with their capital. And there's 3 specific things that they're doing the math on to get to the right outcome. They can defend existing positions, but that could be at returns that are potentially dilutive to their original underwrite. They can do new deals without deplete that capital balance. Or 3, they're coming to us. And they're coming to us as a solutions-based provider where we can kind of come in, partner with companies, help companies unlock enterprise value, deleverage balance sheets, recapitalize balance sheets, to where a sponsor is willing to say, I will effectively trade IRR today for duration extension tomorrow for a better equity return when those 3 exit paths come back to the market. And so we're seeing a lot of opportunity on this installed asset base as the market continues to kind of digest a higher rate environment. And when you look on the next page, this kind of just juxtaposes the two environments. When rates were low, in addition to aged assets, we also think the refinancing opportunity for both publicly traded companies and sponsor companies will be with us as well in this higher rate environment. And remember, we're at 4.5% right now. Even in a lower rate environment, call it 3.5%. This opportunity will be with us for the foreseeable future. Where you see on the left, when rates were low at a 6% cost of capital for an LBO, fixed charge coverage ratios were rather healthy, around 2 times. Cash flow could be reinvested back into the business, and you could grow organically and or do M&A. And that was usually how companies were able to exit and grow EBITDA from that perspective. Fast forward to today, cost of capital has doubled. That 6% floating rate note usually is now coming due. It needs a refinancing opportunity. And as you can see here on the right, in this refinancing example, you can get around 4 turns of debt roughly, a lower quantum of debt, but at that higher rate. And there's that 3.5 turns of a capital need that we can kind of come in to kind of fill that void, really partner with these sponsors where there's strong institutional equity support below us. We believe really attractive returns, very good downside protection in terms of how we structure these types of deals, and really be that partner to help refinance these capital structures. So we see this opportunity set, with us now in the foreseeable future in this type of environment. And we're excited about all the opportunities that are coming to us. So with that, I'll pass it over to Patrick to talk about the exciting opportunities in infra debt.
Great. Thank you, Craig. Thank you, Keith. Firstly, I'd like to open up and introduce myself. I'm Patrick Trers, the Global Head of Infrastructure Debt at Ares. And at Ares, we have a true global infrastructure debt platform. We have an office in New York, London, APAC, but that drives, as you heard from my colleagues today, really strong origination, and we're able to support our sponsors all over the world. But across the infrastructure credit space, we believe this is a pivotal moment in time. There are 3 mega trends that are driving this opportunity set. Across those mega trends, and you heard from Mike today, this is not a market that we can measure in billions. It's $1 trillion market opportunity. And that annual spend is increasing year on year. And at Ares, we're at the forefront of that, having that true global presence. Across the mega trends, we see energy transition, we see digital, and we see transport and mobility. Across the energy space, we're seeing the shift from fossil fuels to more sustainable energy. Across the digital space, that's really driving data centers, data consumption. We're seeing the huge shift, as we all spoke about here, and think about AI, that's creating the data centers are the epicenter of our daily lives. Across the transport and mobility, I think what we've seen over the last few years is that we've seen, increased demand for people moving and goods. That's across airports. But just capping up on the mega trends, the digital revolution is upon us. I think when we witnessed the introduction of the internet many years ago, but now we're seeing the introduction of the data consumption. And what does that mean? That really creates enormous opportunities for Ares to be a capital provider and capitalize on this huge opportunity in the infrastructure space. I think, shifting across, I'd like to really speak about the capital dynamics and sort of point out 2 key observations that are driving this funding gap. Infrastructure equity funds have got larger. There is shortage in credit. Government budgets remain stretched, and the spending capabilities across the world to fund this infrastructure spend. But just expanding on the funding gap, equity funds have raised over $1 trillion versus $100 billion on the credit side. So, just by nature, credit funds should be 3x the size of an equity fund. So there's a scarcity in credit, and that's real. And at Ares, we are ideally positioned to work on this market. Across our pipeline, just to speak to that, we've got $5 billion of credit opportunities. And on the government side, we're seeing the rising rates across the world. That's putting pressure on governments to keep up with their debt balances. And so it's estimated in the US that about 50% of the federal tax receipts will be used to fund their basically existing debt. So there's a huge capital demand for infrastructure, and at Ares, we're nicely positioned to be that infrastructure capital solutions provider. As we see the growth, we don't see this slowing down anytime soon. This is a market that's gone from strength to strength. The chart on the right-hand side will show that the M&A activity has slowed down, yet our pipeline of activity has not slowed down. This opportunity set has really been driven by 3 items. They are refinancings, grow CapEx, and recaps. But just across the grow CapEx, as we look at the data center and the whole digital revolution that's underway, we're at the forefront of that, financing all of these opportunities. But just to sum it all up, it feels like we're just at the tip of the iceberg here. There's huge opportunity here in the infrastructure space, and we're seeing that it's a flight to quality as they back these infrastructure assets that are critical to the economy. But with that, I'd like to pass on to my partner and colleague, Brian Donahue, on the real estate debt platform.
Thank you. Thanks, Patrick, and thanks for the time today. Grab that clicker from you. It's tough to clean up here, but I'm going to try to walk through real estate credit without being overly redundant, with two exceptions. One is, I think my colleagues up here today, we share the scale of the opportunity set in front of us. It's unabashed, and we're excited about it. We have a huge addressable universe, and real estate debt is a proxy for a lot of what we're talking about, given the manner in which it has been historically financed. Now, normally real estate gets into the headlines based on the oversupply of underlying assets, right? That was the GFC, that was the S&L crisis. And we sit here today somewhat uniquely with the fundamental backdrop away from the office sector, undersupplied, long-term, positive supply-demand fundamentals in logistics, in housing, in the US and in Europe. So if you look at the way this asset class has been historically financed, largely banks have been the dominant player. And Keith touched on this earlier, as well as his colleague Joel, about the way those liabilities and assets matched up. And so what's driving some of this change? We talked about some of it from a secular perspective, but office exposure, right? If you look at private versus public exposure to the space, and that is the one subsector where there is oversupply, well-publicized headlines there. The office exposure becomes this capital drain, both in terms of human capital as well as financial capital. So when you pull both of those back alongside the regulatory framework that we're all sharing today, it creates a vacuum of capital. Now, when you add to the equation the increase in rates that we've seen over the past 2.5 odd years, it hurts the liability structures, and certainly it hurts the asset values. And so that vacuum of capital leaving the system creates this wall of maturities that's been characterized, $150 billion annually of maturities that will have to be refinanced by someone other than their legacy holder of those assets. You may have seen this in the press around a refinancing wave. The connotation of the wave, the way it's being expressed, is that it's a one-time event. And Patrick, you touched on this a little bit. This is not a one-time event. This is a long-term secular shift in the way these assets are leveraged. And it's not that the banks are leaving our space, quite the opposite. We hear us at Ares talk a lot about the partnership that we have with the banking institutions across every part of what you've heard about thus far today and for the rest of the day. The banks are being encouraged and taking the bait to shift into levering the private providers of capital in our space. And it's a positive change overall for the system in which we all inhabit. So lenders to lenders rather than direct lenders to the underlying real estate. But with that shift, right, you're taking that same supply and demand dynamic. There's less supply of capital to commercial real estate today. We have the benefit of the increased rates. We have enhanced pricing from the spread increase because of that vacuum of capital that exists. But I think an important point that may be a little bit subtle here is private lenders in commercial real estate debt are less levered than financial institutions historically were. So with that reduction in leverage, right, a deleveraging cycle that started with REITs 20 years ago, lower LTVs in public REIT sector, the commercial real estate market will benefit from the lower leverage that lenders will apply to the sector going forward. But the benefit, right, we talk about compound income ad nauseum here at Ares and the benefits of it. But if you look at what's going on, what the offensive side of the ledger looks like today, it's higher base rates, reset valuations, better covenants, and overall better yields. So one of the more compelling opportunity sets that I've seen within my 25-year career. And I see the time ticking down. Hopefully we did a good job of covering what is a vast opportunity set that we see throughout Ares and for the four of us on the stage today. And with that, I will turn it over to my good friends, Julie and Keith, for the next section. Thank you, everybody.